Hi, everyone. I'm David Silver, CEO of Instrumental Wealth. Joining me today is Matt Harbert, Chief Investment Officer. And Matt, there's a lot to get into today as far as all of the highlights that went on both with the economy as well as markets last year. So I know our clients always find these videos super informative, and there's a lot of great information that you're able to share with us. So I want to jump right into it.
Okay. Well, why don't we go ahead and start off with the economy? 2024 was actually an interesting year for the economy. There's been some changes in several of the areas that we've been paying attention to and have talked about over the last few videos we had. Um, First is inflation. Inflation has made some meaningful progress towards the Federal Reserve's 2% target in 2024. However, this downward momentum slowed a bit over the fourth quarter. If you look at this chart, this gives us the year-over-year changes of inflation. Looking at the purple line, that's the headline CPI. You can see by the end of December, it was showing a 2.9% increase in prices year over year. Now, compared to the previous quarter, it's a little bit higher. Previously, it was at 2.4%. So you can see how it's ticked up just a little bit over that fourth quarter. The orange line here are core prices. So unlike the headline prices, they actually have been pretty much stable through that period of time. So you can see that that downward trend that was occurring has either flattened out for the core or even ticked up a little bit when looking at the headline prices. Now, breaking this down to the different components of CPI, kind of on the positive side first, if we look at core goods, that's about halfway down in the table where it says commodities less food and energy commodities. They've really been a steady source of deflation through the year. However, you can see kind of hitting around October, September, October time, really started to tick up a little bit there, started to creep up a little bit. And that was really largely due to rising vehicle prices. But overall, for the year of 2024, you can see that last column that core commodities were still deflationary. So they were still down 0.5% for the year. When we look up closer to the top of the table, under energy, you'll see gasoline. Gasoline prices, sort of a similar story there. They were very deflationary throughout the year up until about November. So in November, they started to rise a little bit again. And you can see in December, really ticked up, really had an increase of 4.4%. That's not too much of a surprise. I mean, the reason that this is left out of the core number is because it's one of those very volatile areas. So we do expect to see kind of big changes either on the up or down side that can be fairly high. But overall, again, if you look at gasoline prices for the year, they have been deflationary for the years. They've fallen 3.4% over that time. Looking at food inflation, that's really been pretty mild through the year. It has been positive, but hasn't seen anything extreme. It's been fairly consistent. And that really brings us to kind of the key contributors to inflation, which is shelter and auto insurance. You can see shelter on the bottom of the table, kind of third line up. This is a very big component of the CPI basket. It's over a third of the basket. And this has remained stubbornly high all year. So that's been one of the biggest challenges. If you look at that year over year, it's actually up 4.6%. The other area that's really added to inflation has been transportation services. It's up 7.3% for the year. We did see some easing in October and November. but it did kick up again in December. It's not on the table here, but this has really been driven by the subcategory auto insurance. It's really may compress all of that gain. So, what do we think about inflation going forward? Really, that kind of recent downshift of momentum and that creep up we've seen in prices over the past couple of months um, have added to fears that this downward trend of inflation has stalled overall. Added to that, the incoming Trump administration's policies are likely to be a little bit more inflationary. If you look at some of the areas that they're proposing, first is tariffs. If we assume the 20% universal tariff with an additional tariff on Chinese imports of around 60%, the calculations by the Tax Foundation suggest that average tariff rate on U.S. imports could rise to 17.7% in 2025. Now, to put that in perspective, the last one they did 2 years ago was 2.4%. So that's a fairly big increase, and that would certainly put some upward pressure on prices. Secondly, when we look at taxes, the administration is likely to push for reducing taxes further. And as an expansionary policy, this would also likely put some additional pressures to prices. And finally, their stance on immigration. As immigration has been soaring, employers have been able to fill jobs without putting a whole lot of extra pressure on wages. But if we see a significant restriction on immigration, this could add to higher inflation through some higher wages. So kind of going forward, we do think that inflation is likely to have challenges in order to get down to that 2% target of the Fed. So that takes us to the U.S. economy as a whole. Overall, the U.S. economy has continued to be healthy. I mean, 2024 was another good year for the U.S. economy. If you look at this table, this gives real GDP. You can see that the most recent estimate for the third quarter of 24 showed an annualized rate of 3.1%. And that is well above that 2.3% average rate from 2000 to 2023. So it's still very healthy. If we look at the table and the individual components, breaking that down, we can see that business investment has remained healthy, even though they've been facing higher borrowing costs. That's likely been supported due to strong corporate balance sheets, as well as a lot of fiscal support. Government spending, not surprisingly, has continued to look solid. And probably the big negative area has been residential. That residential component has been a detractor, primarily due to the elevated mortgage rates that we have seen. Now, that said, really the big driver of GDP has been consumption. And given that consumption is actually around 70% of the US economy, it's not a surprise that the health of the economy is closely tied to that of the consumer. You can see, looking at the table, if you look at that line in blue, that it has contributed 2.5 percentage points to that overall 3.1% increase in real GDP. Also, if you look at kind of the bar charts on the bottom, to the right, you'll see 2024, and that dark blue portion of those bar charts is consumption. And you can see just all year long, that's really been the driver, actually going back even to early 2023. Really, it's been driven by a strong consumer. So looking at the employment side of things, the labor market has been normalizing from its post-pandemic boom. If you look at the chart on the left and the upper middle chart, that shows us job openings and job quits. We can see they've both fallen very significantly since that time in 2022. But overall, you can also see that historically, they're still quite strong. If you look at the chart on the right and see the payroll gains, they've also been declining. And if you kind of look at that, the blue bars on the bottom right, you'll see that area, kind of that September, October area, had a really unusually low gain in there. That was really primarily due to an adjustment that the BLS had made in their calculations, as well as there were several strikes going on at the time and the effects that we had from the various storms hitting the country. But since then, you can see that it's really kind of settled into a relatively healthy pace as well. Now, that said, as we mentioned earlier, the Trump administration has expressed the intent to take a tougher stance on immigration. This could have meaningful implications on the labor market in 2025 and beyond. We'll just have to kind of keep our eyes open and see how that all works out, whether they get what they want passed, what kind of implications we have there. As far as unemployment goes, that is actually the black line on this chart. After rising the first half of 2024, the unemployment rate has stabilized towards the end of the year. Into December, it's sitting at about 4.1%. Now that is meaningfully above the cycle low of 3.4% last April of 2023. But it still remains lower than about 88% of the time over the past 50 years. So while it's increased a bit from its cycle low, historically, we're still at a very low rate of unemployment. In addition, steady economic growth should continue to support decent job gains, reducing any further rise in unemployment. And interestingly, as we talked about with the Trump administration immigration policies, if the labor force actually slows, if that growth slows due to a restriction on immigration, that actually could end up lowering the unemployment rate as well. So overall in 2024, the economy has been in a firm expansion. Consumer spending has remained solid. The labor markets have been normalizing, but they still continue to be healthy. And we've actually seen earning trends improve as well over that time. And that brings us to what potentially or arguably has been the biggest news of 2024, and that is the change we saw in Federal Reserve policy. So with inflation that has been trending lower and the labor market softening kind of earlier in the year, the Federal Reserve started their easing cycle. They cut rates by 50 basis points over their September meeting. They followed that with a 25 basis point cut in November and another 25 basis point cut in December. This chart shows you the federal funds rate target range that they've set. So you can see that they're currently sitting at about a 4.25% to 4.5% target range. So they've actually reduced the target by 100 basis points over 2024. That said, their projections over the December meeting, the projections they had for 2025 actually ended up more hawkish than previously expected. So Chairman Powell noted that he remains optimistic about the health of the economy and that downside risks to the labor market have basically diminished. But he also noted that inflation, while moving in the right direction, has been hotter than expected in the more recent months. So based on the projections of solid economic activity and this increased inflation uncertainty, they changed their expectations to only 2 rate cuts in 25, where in the September meeting, they were projecting 4 rate cuts. So they have become a little bit more hawkish. This chart, if you look to the right of this chart, you'll see those dark blue diamonds. That's giving us the Fed's sort of mean projection of where they think the target rate will be, or the Fed funds rate will be in each of the years going out, plus their long-term expectation of that. Now, interestingly, if you look at those green dots, those are actually the market's expectations of where the market thinks rates will be. And you can see they're quite a bit more hawkish than the Fed's forecast. And that is likely due to investors' growing fear that inflation is going to remain higher longer. That's going to be harder for the Fed to get that down to their 2% rate. And that'll end up leading the Fed to slow down rate cuts even further, potentially even putting a pause on rates altogether. Now, if we look at the more short-term market expectations on rates, this is the probability the market is putting into what the Fed will do in this week's meeting. And it's nearly 100% that they feel that rates are going to be a pause. They don't think the Fed's going to cut this meeting. And I don't have the chart up here now, but if you go out and look at the probability for the March meeting, they're actually showing about a 75% probability of a pause as well. So overall, when you look at kind of Fed policy, they have started cutting rates. They started in September. They've dropped them 100 basis points. But as we saw, economy remains strong. We've seen that sort of leveling out of inflation. Powell has noted that they will slow down the rate of cut to only 2 versus the previous 4. So I don't think I think it's safe to bet that they're going to be not cutting rates in this January meeting. And that's it on the economic side.
Super helpful and a lot of great information in there, Matt. Let's transition a little bit from talking about the economy to talking about markets.
Okay. So why don't we start out with the equity side of the markets? Looking at global equities, kind of the broad categories overall, you can see that 2024 was actually a decent year for equity markets. As has been the case quarter after quarter, the U.S. Equities have continued to be the top performers. You can see in this chart that U.S. large, U.S. mid, U.S. small have outperformed all of the international equities, both the developed and the emerging markets. International developed equities really ended up the year with the worst performance. They were only 3.82%. And we actually did experience a bit of a pullback in December across all of the equities, which did result it was probably a result of investors' concern over that inflation, that expectations of what the Fed's going to do going forward that we just talked about. So that pullback actually, while 2024 was good for equities, that pullback actually did result in each of the asset classes closing below their all-time highs. U.S. small and developed markets were both down around 8 to 10% off their highs. Now, however, emerging markets really never traded at their high in 2024. So while they're 18% off their highs, it's not as much of a surprise because they never actually traded at their high. While most of the other asset classes all reached a new high during the year. Kind of breaking this down to U.S. equities, 2024 was actually another great year for U.S. large cap equities. They easily outperformed all of the other broad equity classes out there. You see large cap was up over 25 or up around 25%, which easily outperformed cash, bonds, as well as all of the other international and smaller cap stocks. But this chart actually is interesting because it shows you kind of how they did in the first half of the year versus the second half of the year. So the white bar is first half of 2024. The yellow bars are the second half of 2024. And, while the US large caps actually outperformed for the full year, you can see in the second half, it was actually small caps that started to recover and make up some ground over that time period. So one of the things this does actually highlighted is that you don't necessarily want your portfolios to get too concentrated in any one type of exposure. So it is to your advantage to have some diversification into other areas of the market. So when a shift like this happens, you have some exposure in those areas. So it definitely was a different tale for the first half than the second half of the year in equities. That gets us to the Mag 7 stocks. So, I mean, this is the story we've been talking about for about a year and a half, that the Mag 7 stocks have really been the key driver of the US market, the US large cap market. And that was the same for 2024 as well. When you look at the orange area on here, that's the total return for the S&P 500. It was up 23.31% in 2024. But if you look at that green line, that's the Mag 7, how those 7 stocks performed. They're actually up 46.31%. While the remaining 493, they were up only 13.38%. Now, that 13.38%, interestingly, for the remaining 493, well, they were well outshone by the Mag 7. That 13.38% actually outperformed all of the other asset classes out there, except for mid cap, which they were roughly equal to for the year. So that actually shows you how strong the US large cap market has been, that even if you look at the bottom performers, those bottom performers still outperformed the remaining equities out there. Actually, in fact, all asset classes out there. Getting to what's driving this, we've actually talked about this the last couple of quarters. It's not really a surprise that Mag 7 has outperformed the remaining part, because it's really where the earnings have been. If you look at those 7 companies, earnings in 2023 grew by 31%. In 2024, they grew by 36%. If you compare that to the remaining 493 companies, those companies actually contracted in 2023 by 4%. And then last year, they grew by only 3%. So it's, there is some fundamental justification to why those 7 companies are outperforming the remaining companies, and it's really that foundation of earnings. And we've talked about this, like I said, last couple of quarters, but the consensus estimates for 2025 are that the Mag 7's earnings are going to decelerate. And while still strong, they're expected to decelerate down to about 21% in 25, while the earnings per share for the remaining 493 are expected to accelerate up to about 13%. So there's still going to be stronger earnings from the Mag 7 if you look at consensus estimates, but that spread between the two, significantly narrows. And that should be, the catalyst we're kind of looking for to bring about that broadening out of the benchmark. In addition, just the sectors as a whole, expectations just by the end of the first quarter of 25, the projections are that we're going to have positive growth for 10 out of 11 sectors. And if you look back at early 23, only 4 out of those 11 sectors were positive. So not just a broadening out in earnings and in the particular companies, but even out in the sectors as well. When we look at valuations with US large cap as well, certainly they've become rich. If you look at this table, you can see they're sitting currently around 22 times earnings for the forward PE. And that actually is pretty close to where we saw the peak during the dot-com bubble. So you get an idea, you can see the perspective of how rich it actually is right now. And if you look at some of the other valuation metrics on there, like price to book or price to cash flow, you can see those are also similarly elevated. This doesn't actually give us a lot of information over kind of short-term returns, but historically, these high valuations are generally followed by lower, longer-term returns. So that's just to keep in mind that we are seeing some high valuations, and historically that could lead to, you know, lower expectations for returns in the longer term. Some of the drivers of the evaluations, it gets back to those mega tech stocks that we're talking about. If we actually look at the top 10 largest stocks, those forward PEs are sitting at over 30 times, which is about 150 times or 150% of their long-term average. And the reason this is kind of a big concern is that those top 10 stocks make up about 40% of the index. So we do see it's the index is very concentrated, and it's concentrated in those top 10 stocks that are sitting at a very high valuation. Valuations for the remaining stocks are also elevated, but not quite as much. They're actually under 120% of their long-term average. So still elevated across the board, but much more concentrated in those top 10 names. That brings us to fixed income. So how did fixed income do in 2024? It has actually been another tough year for fixed income. So overall, returns were disappointing. But there were a couple of bright spots. You can see on this chart, if you look at that light green line, that's high yield. So there's been strength in those credit markets. And that dark green line is the cash. So cash and high yields actually had a decent year last year, but overall, when you look at the other categories, they've all been very middling around 1.5%. And then even if you look at international equities, they were the worst performing. They were down 4%. BlackRock last year had a poll of advisors about what their expectations, and most advisors were actually ready to increase duration. Expectations of falling inflation, and we were beginning the year expecting several rate cuts as well from the Fed. So the projections were that 2024 would actually be a very good year for bonds. Bonds historically have done well when the Fed cuts rates, but that actually didn't happen this year. If you look at this chart, that yellow line is the Fed funds rate, so that's Fed policy, and you can see where they started rate cuts in September. And then the red line, that's the 10-year Treasury, and so we can see what happened with rates through the year, and particularly after the Fed cut rate. So you can see rates are actually falling leading up to that first cut from the Fed. And that was really based on expectations. The Fed was going to be, that we just mentioned, there was going to be a lot more cuts by the Fed than actually happened. There was going to be, the expectations were very positive. And then when the Fed cut rates, that actually rates did fall a little bit after that. But then, as you can see, kind of in September, they started to hike back up. Now, why was that? What followed that rate cut was much of what we just talked about in the economy. The economy ended up becoming stronger than expected, and inflation ended up heating up a little bit. So really led to expectations of less future rate cuts, of a more hawkish Fed, and that really ended up spooking investors a little bit. So that brought rates back up a little bit. Instead of that expected decline in rates after the rate cut, we ended up seeing In fact, actually an increase in rates over that period. So this is also something that BlackRock put together, which is pretty interesting. It actually breaks out the returns of each of these different fixed income sectors and where they came from. So that the areas in yellow are really driven by that duration part, where red or that orange is income. So duration, as you can see in most of those sectors, have been either negative or just non-existent. So that duration that everybody was hoping to benefit from this year really just didn't work out. But you can see the income side of things actually were pretty positive through the year. Um, in addition to that, shorter term bonds, you can see did pretty well, much better than some of the other areas. But in fact, it was that credit area. So that bar chart to the right, that high yield credit, they actually outperformed everybody. They were not only able to take advantage of um, higher yields, so you can see 5.9% of their returns are driven by income, the yields, but they actually, since things work a little bit different in that high yield credit area, um, really looking at spreads, there were tightening spreads that they were able to take advantage of. So they were one of the few areas that got some capital appreciation on top of the income as well. So it actually was a pretty good year for credit markets.
A lot of great details in there. Thank you.
All right. So uh, key takeaways from 2024. If we start with the economy, um, you know, the 2-year drop in U.S. inflation rates, stalled towards the end of the year. So probably not going to see that fast reduction over 2025, um, particularly with additional pressures on prices, with the additional policies from the incoming administration. So we do expect to have continued challenges for inflation to reach that 2% target. We do think there's going to continue to be steady economic growth. Corporate profits are expected to still be very positive and remain at a healthy pace. So hiring, job growth should still be healthy. Um, Restricted immigration could add some headwinds to that, but as we mentioned, we'll just kind of have to keep an eye out and see how the impacts there. Despite the Fed's easing cycle, we may not see those market interest rates fall as we would expect during those type of periods, kind of how we discussed. Expectations are built into a lot of that. And if the expectations are the Fed isn't going to ease quickly or even stall out, that could be, have a negative impact on rates. Mortgage rates are likely to remain high. Housing market is probably going to stay frozen going forward for a little while. And the economy, we do expect to remain moderately healthy. We don't expect a recession over 2025. And then markets, U.S. equities are likely to continue to outperform other asset classes, but we do expect to see a broadening out of that large cap sector that has been so concentrated, particularly in those Mag 7 stocks. So it might actually be a time where the equal weighted index might actually do better than the market cap index. This also offers some opportunity in security selection on the equity side, and curve positioning on the bond side is probably where they're going to get their advantages going forward. We do think alternatives will be a good diversification, particularly with some of the policies coming in for the Trump administration. We do expect that could be very positive on alternatives, particularly some of the private markets, as it thaws out some of those mergers and acquisitions. Finally, investors might face some below average asset returns. There's just been so much positive that has been baked into the markets currently. We already saw kind of this pullback in December when there was some of the repricing of the expectations on the inflation and Fed rate side. But there's also a lot of positive expectations built in growth in other areas. So we may not have as high returns going forward as a lot of that's already priced into the market. And that concludes.
That's super helpful. I know our clients always love when you do these presentations. We get so many different questions from clients and so much great feedback. So thanks for sharing a couple of nuggets of wisdom here with everybody. And certainly if you're watching this and you have any questions for us or Matt in particular, feel free to reach out to us on our website at instrumentalwealth.com. Schedule some time with one of our advisors. We'd love to have a deeper conversation with you around this if you have additional questions. So thanks, everyone. And here's to making 2025 an awesome year. Take care.